You're listening to the Valley Current.
Hey, Joe.
Here you go. How are you?
What a day. I can't believe it.
Man, did you know anything? When I sent that to you, I don't know, it was this morning, man, it was just it's unbelievable. We were just not talking about it, but we were talking about the concerns we had of the economy, right? Look at that.
I know. It's like with the intuition that something wasn't quite right. And I have to tell you, there are people that trace this entire Silicon Valley Bank thing, and we're talking about the company. It's actually a public bank.
Right.
The company. It's on the stock exchange. The stock price dropped from 260 to under 26, 90% reduction in like 2 or 3 days. And there are people that are saying that this all started because a hedge fund called Union Square Ventures or Union Square Partners, I want to say they're in New York, did a newsletter or something that said, look, this situation with these crypto firms going under like FTX and Silvergate, Silicon Valley Bank has a lot of these startups that are fintech startups. And they sort of made a prediction that Silicon Valley Bank is going to be in trouble and is not going to have liquidity. You know, there's two concepts here. One is solvency and the other is liquidity.
Right.
Solvency is, you know, do you have assets that are greater than your liabilities?
Right. Liquidity
is when the bank's depositors all start asking for their money at the same time. It's like someone screaming fire in a theater. And everyone's racing to the door and no one can get through it. And the door is like small, like a funnel. And you have to wonder, would you want to be the CEO of Silicon Valley Bank right now?
Wow. So it's interesting, the take on what's your take so far? There's a lot of information flowing into the networks and newses, but first, you're wondering if this is going to be a national problem with all banks, but then you hear some stories. Well, it's just a bank that's highly, leveraged with high tech startups, and it's a very individual thing. But then you see First Republic taking a big hit today. Does this look like a Silicon Valley thing or only?
No, look, these banks are all interconnected, and they're even internationally connected, because Silicon Valley Bank was the gateway for lots of Chinese startups to get essentially their U.S. banking set up. And the dirty secret, I'm not going to say it's dirty, and it's probably not a secret, but I call it the dirty secret, is that the reason VCs in Silicon Valley and even VCs on the East Coast funnel clients to Silicon Valley Bank is because Silicon Valley Bank is much more willing to extend the line of credit to a startup. So let's say you have a startup and you raise your first round of venture capital, typically Series A preferred stock. And typically these days, the deals are at least 5 or 10 million of new cash going in at a very high valuation for a Series A. Everything's kind of shifted to higher valuations. That deposit goes into Silicon Valley Bank. Silicon Valley Bank will often say, we will extend an additional line of credit behind that deposit.
Oh, okay.
And the reason they do it is they say to themselves, and this is an interesting thought, well, if a venture capital firm is putting $5 million in, they're like going to backstop the startup. They're going to make sure the startup doesn't go under because they've got $5 million and they're going to put more money, good money after bad, you could argue, or you could argue they're going to get rid of management and do a pivot or a restart. So our line of credit is pretty secure, even though we are extending the runway, because when they burn through that $5 million, they're also going to burn through that line of credit. And usually Silicon Valley Bank does not get a guarantee from the VC firms. They don't get a formal one. They get kind of a handshake. you're going to tell us if things are sideways or whatever. The VCs seem to have turned on Silicon Valley Bank. I don't get why the
I don't either.
why Becker, Gary Becker's the CEO, why he didn't have like a lineup of VCs standing up next to him yesterday saying, we fully support the bank. We're going to tell our founders to keep the money there. The VCs did the opposite. They were like, take the money out. They kind of...
Yeah. You wonder if the bigger picture will probably unfold in the next couple of weeks, but it would seem like they're shooting themselves in the foot because they kind of need them as partners. But is there something going on where that relationship's going to diminish, or maybe they don't need them anymore? And then the other thing I'll say is, as I listen to you, is that you know better than anybody, and so do I, that it's kind of funny, again, unless you get caught up in that frothy kind of hit the home run stuff. What is it? 10% of all venture capitals turn into something. I mean, it's very, right. It's very minimal.
It's very minimal, but there's sort of a view that there's enough of a way to maneuver an exit so that the debt gets paid. Like usually there's enough of an asset.
I see.
If the intellectual property is developed and patents are filed and IP is obtained, there's a base of assets. Now, it's not tangible. It's hard to value. It's not like real estate. It's not like, inventory of product. It tends to be difficult, but usually Silicon Valley Bank will get paid back on its line of credit. Now, here you've got an interesting situation because now I imagine the bank is going to terminate all those lines of credit. Certainly, right. FDIC, which took over this afternoon, will do that. So all of those founders, this is your point, they may have shot themselves in the foot. So all those founders have lost runway. Right. Runway that might have existed on that line of credit, unless they already drew down the line of credit, in which case it's going to be some interesting litigation trying to get that money back, because the FDIC effectively has put the bank into receivership, which is pretty close to a federal bankruptcy, but it's not a federal bankruptcy because, in fact, the assets are greater than the liabilities, and now it's just an orderly disposition. And the folks who get most hurt here are the shareholders. The shareholders basically go to zero.
Yeah. I just have to believe that this is going to send shockwaves, because we all know what happens here. First of all, I don't think it's just limited to Silicon Valley. And secondly, what's going to happen, and when something like this happens, I remember in 08 and 09, now everybody's going to start really getting under the hood and looking more. Yeah, we all kind of think things are running okay. And then now you're going to have a lot of scrutiny, don't you think? And double checking and triple checking, and what kind of bonds they hold, and what are the rates, and how much capital do they need? One of the things I do know of being in the business that I've been for years, the only way lenders and banks get money is that, raise capital. They have to sell mortgage-backed securities. They have to sell loans. They have to sell blocks of securities to raise capital. They can't make a living alone on portfolio loans and collecting an interest rate all year long.
To me, the FDIC has got to make a bunch of calls at the highest level. I don't know to what extent the Federal Reserve, will get involved, whether Powell pick up the phone and call up people like Jamie Dimon over at
Chase,
JP Morgan, and say, look, we don't want contagion. We don't want people running to their banks. This small world thing here.
I know.
I had a conversation with a gentleman who's in his 90s. This was about a month ago. And he said to me, I'm out of the stock market. I basically am in my 90s. I'm okay getting 3% interest.
Yeah.
Divide my money. I forget what he has, but let's say he's got a few $1 million. I've got like 10 bank accounts with no more than a couple $100,000 in each, because my wife died, so I don't get the benefit of the $500,000.
I see.
Ceiling, $250. I've got them spread across like 10 different bank accounts at 10 different banks.
Wow.
So he's being ultra conservative. Mm-hmm. And here's a good example why. because a bank can go under.
Right.
And when there's a run on the bank, which is totally psychological, it's totally about fear. It's totally about lack of confidence. It's totally about, we don't really know what we don't know. So what's the point? If there's a 1% chance, get the money out before something goes bad. It's not worth doing.
Right.
It's amazing to me because it's like such risk aversion. These, of course, are people that are meant to sort of say, hey, we're not going to a casino if we put money into a bank. The bank is supposed to be there. And the FDIC represents kind of the ultimate guarantee up to that $250,000 cap. Now, if a $5 million Series A round was just closed, let's say, and you as the founder deposited Silicon Valley Bank last month, and you got a line of credit and everything seemed just perfect, you were financed, you wake up this morning and you can't get access to funds. How do you cover payroll?
You're right. Right. And then
you're screaming. You're screaming at this point.
No, you're right, Jack. And then there's a ripple effect that a lot of people don't think about. How do you meet payroll? How do you start paying for your lease payments? And then do employees get spooked and they start leaving, right? I mean, all kinds of things happen.
Yeah, employees, and remember, you are now in a semi-virtual approach, so it's not like you can sit everyone down around the table and say, look, we're going to get our money, we're going to get it by Monday, relax. You have to do it by Zoom and maybe by text message, and whether people believe it. I mean, we have a deal that's closing right now. I won't mention what it is, but several $1 million was supposed to be wired to our trust account, which is at Silicon Valley Bank. And I said, stop the wire. Stop the wire. We've got to get that money wired to a different account because we can't be in the middle of a situation where even a state bar approved trust account, which happens to be at Silicon Valley Bank, that doesn't have any super priority. Maybe it should. Maybe the state bar, if they're listening, State Bar of California should say, look, those accounts need to be given super priority because they're trust monies. They're not owned by the law firm.
Right.
The interest gets paid to the state bar as part of the program to manage its affairs.
So you caught that in time, though. Good.
Yeah, caught it on time, but think about it. The luck, the bad luck of having that several $1 million hit Silicon Valley Bank, if knock on wood, it didn't happen, but had it happened and this were news, it would have been a sleepless night, a sleepless weekend. It would have been me saying, golly, gee, how does stuff like this happen? And it does happen. It's beyond your control. You couldn't have predicted it. I mean, who's going to look and scan through whatever reports they issue to whoever they issue them to, whether they're the SEC or the bank controller, to see, well, what's the quality of their assets and how much liquidity do they actually have? I mean, you know, this guy, Gary Becker, the CEO, is a 30-year veteran. He started almost like in the mailroom, like literally started 30 years ago. He's a graduate of Indiana University. You know, think about him from a career point of view. He is trying to assure everyone yesterday it didn't work. It kind of backfired. People treated it like, because he said something like, everything's fine. We have, I'm not going to quote him exactly, but I saw the video of it. And it was something like, everything's fine. We're going to be fine unless all of you tell your clients to remove the money. Then we're in trouble. Well, guess what? That's what they did. That's what they did. That's what they did. It's like you should have just bit your tongue after everything was fine and stopped there, right? You know, maybe you need Warren Buffett next to you, and you were hugging Warren Buffett right next to you, right?
Right. What's the you know, when you tell this story, and here we are hundreds of years later, I don't even know, I'm just guessing, but what's the famous Christmas story where they get the run on the bank in that little small town? And I can't even think of it. Jimmy Stewart plays it. It's a famous Christmas movie that plays every year. He's a banker, and they get into trouble, and literally people are lined up writing notes saying, "This here, I want my money. I want my money." Well, here we are several hundred years later, and the same thing happens.
Well, it's a known problem. It's sort of like I often think of Ponzi schemes are known problems. They don't go away, even with regulation. It's like, bank runs happen. Psychology is an amorphous thing.
Yeah.
Fear is an amorphous thing. It might be It's a Wonderful Life. I want to say that's what it is, right?
That's it.
You're right. I mean, there's a good example of how is it that we can have in the 21st century a bank run? And, I have to say, what some people say is it's more likely that you would have it in the 21st century, because in the 21st century, you've got information traveling so fast, so furiously, that you're just amazed at how quickly this data flows. I mean, it flows so quickly that you can't control it. I mean, it's like someone could create a rumor in a second. Like if someone announced on the internet, a nuclear missile has just been launched from Russia into the Ukraine, I think a lot of people would believe it. Now, I don't know what they would do about it, but I think they would believe it. If they went on YouTube saying it and they showed a missile, you remember that story of the War of the Worlds, which was remember?
Yeah.
So I've got the movie up. If you got a minute, this is like a 2-minute. Since you raised it, let me put it on the screen. This is The Wonderful Life. Of course, you have to do a commercial. Hold on a second.
I'm getting the image of Silicon Valley Bank here 200 years later. I mean,
let me see if I can get it up on the screen. Wow, there they are lined up.
I mean, look at that. That's what happened yesterday, right? Although electronically instead of physically.
Right.
Yeah. That's amazing.
For you folks, I just talked to old man Potter, and he's guaranteed cash payments to the bank. The bank's going to reopen next week.
But George, I got my money here. Did he guarantee this place?
Well, no, Charlie, I didn't even ask him. We don't need Potter over here.
I'll take mine now.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
I got $242 in here, and $242 isn't going to break anybody.
Okay, Tom. All right. Here you are. You sign this. You get your money in 60 days.
60 days?
Well, that's what you agreed to when you bought your shares.
Did you get your money?
No.
Well, I did. Old man Potter will pay 50 cents on the dollar for every share you've got.
Look at that. Yeah, wonder if that's coming next.
Exactly. Arbitrage.
Yeah, right.
Better to get half than nothing.
Wow.
Listen to me. I beg of you not to do this thing. If Potter gets a hold of this building and alone, there'll never be another decent house built in this town. He's already got charge of the bank. He's got the bus line, he's got the department stores, and now he's after us. Why? Well, it's very simple, because we're cutting in on his business, that's why.
So you brought up something that's really perfect for discussion, Joe, which is runs on banks have existed since banks have existed. Right. And people that become fearful start to communicate. Usually it's word of mouth, but now it's electronically. It's Twitter, it's
social media,
social media, Facebook. And you can reach a bank to demand a withdrawal with a few clicks. You don't even have to go down to the branch and face the banker. Right. And the banker can't even really face you face to face. It's all electronic. It's all Hollywood, right? I mean, essentially, you could argue if Becker is in pain tonight, Gary Becker, the CEO, good guy, nice guy. It's not the way a guy like his career should end. But if you think about it, he's like, what could I have done differently? I'm not saying he's in despair, but he's got to be asking himself, with all the pain and suffering that's happening here, he's going to lose his job. Mm-hmm. He's lost all of his equity. He owned hundreds of thousands of shares. They were $2.60 a share. They went to zero. And he probably thought the bank is doing just fine, and it was on the face of the numbers on the accounting statements. And all of a sudden, it's like everyone demanded their money, and we couldn't service it. So the feds came in and essentially closed us down. Now, Federal Deposit Insurance Company didn't exist at the time of the Jimmy Stewart movie. It's like 100 years old.
Right.
It's a good example of why it exists, because it represents this safety net. But still, 250,000 is not a lot of money in today's business world.
No, it's not.
It really isn't.
No.
And so can you imagine? Because they do have individual accounts too, Joe. Can you imagine individuals that have Silicon Valley individual accounts saying, well, wait a minute. I mean, what happens to our money? When are we going to get it?
Well, that's you bring up a very good point, Jack. That's why I think people don't understand the far-reaching effects of this is, existing account. Let's say, I mean, they probably have hundreds of companies that have who knows how many millions of dollars in their business checking account and savings account. Do they seize those? Do they not have access to those funds anymore?
They froze everything until Monday.
Wow.
And the FDIC said everyone whose account is under 250,000 will be able to withdraw all the money as of Monday.
Wow.
Anything over 250,000 and you get an IOU. That's what I thought Jimmy Stewart was going to sign. Something that said IOU. That's sort of what he did. He said you get paid in 60 days. Essentially, it's a receivership certificate that you can sell. Think of it like a check,
right?
With a date in the future. Right. So the reason I remember this is, for a brief period of time, the city of New York was in receivership. This was back in the day when I was studying and in graduate school studying computer science in Manhattan. And I worked for the City University of New York in the computing department on 81st Street and 2nd Avenue. And I remember we used to get paper checks. You get twice a month a paper check. Right. They didn't do direct deposit. That's not the way things operated back then. And they delivered a check to my desk, and it wasn't a check. It was something called a warrant, which was effectively saying, I'll gladly pay you Tuesday for your work being done today. The Popeye hamburger thing. Yeah. And I was like, I was just a kid, I mean, I was, maybe 20, whatever I was. It must have been 21 at least. But it was the last year of college and graduate school. I did a combined master's and bachelor's degree. And I was working and riding my bike uptown to kind of get there to save money. It's another story for another day. But I turned to the older person that I worked for, a very nice woman, very smart, got PhD, brilliant person, very great mentor. I learned a lot from her about computer science. And I said, what do I do with this? She said, oh, you get to show that to your landlord and say, eventually they'll get paid their rent out of this. So you haven't lost your job. The good news is you haven't lost your job.
Oh my God.
But you can't get paid right now because the city was in what was called a Big Mac receivership.
Receivership, yeah.
For a period of time where essentially they were controlling the outlays because city was viewed as too bloated and they needed to cut a lot of people. I remember thinking, man, it wasn't bad for me because I had some savings, but can you imagine people that live paycheck to paycheck?
No, I can't. And we have a few minutes left here, but I'll tell you, I think that the message, I'd like to get out and talk a little bit about before we leave is what kind of far-reaching. So what are we looking at next, and what kind of concerns should people have? And this, by the way, also, I started thinking about liquidity. Well, a lot of these mortgage companies and credit unions in Silicon Valley and all over the United States, they write loans, and they what's called portfolio loans. For those that aren't listening, that means they hold them basically for customers, and they hold them, and sometimes they sell them, sometimes they don't. Well, when the market doesn't have an appetite for these, so here's the other problem that I see happening, Jack, is that when the markets get spooked like this, banks have to sell loans and securities and mortgage backs to raise capital. And when there's not an appetite for someone to buy those, they have to raise capital to keep going. And so I'm wondering if the ripple effect, you might say, well, it's Silicon Valley, but I don't think most people understand that this could cause problems with a bank in Chicago or Wisconsin or, Chicago. It'll be interesting to see what happens here, I guess is my point, especially with the mortgage market.
Not just other banks, but to the extent there are startup companies that were on fumes to begin with and thinking they could draw down on the line of credit
That's true. Good point.
There's going to be next week, there's going to be layoff notices from a bunch of different companies. And unless magically JP Morgan or Wells Fargo or Bank of America or Citibank or some big bank comes in after a weekend of negotiations saying, hey, we bought Silicon Valley Bank probably for peanuts, but we're going to inject new capital. Don't worry, everyone's going to get paid. Those lines of credit won't be respected. And there will be the potential for the contagion, that domino effect that you're saying, which is other banks saying, well, if they're failing, then maybe we're going to have a run on our bank, because the psychology becomes one of scarcity.
Yes.
If I don't get my money out, and some people will probably stuff the money into their mattress. They won't even trust it being in a bank anymore.
Yeah.
It's like they'll move it to somewhere else, maybe, something that's like super safe. I don't know what that would be. I mean, imagine if you had a safe deposit box there. Every doors are locked. You can't even get into the building. The security is immense. There were lineups of people.
I'll tell you the other thing, that don't be, a lot of people are like, well, I don't understand this. If the economy is having problems, why do we just add all these jobs? But if you look deeper, again, this is what happens when you get granular. When you look at those jobs today, the majority of these jobs went to blue collar workers. The majority of these jobs are service industry that is trying to catch up after COVID. So my point is, it's going to take a couple of months for this to flush out. High tech's laying off. They get a lot of severance packages before those unemployment things are recorded. I just think we're headed for more troubled times before it gets better. It's somewhat to you and I were talking about yesterday, really, ironically, before this happened.
Right. It's amazing. We were just fingering that something doesn't seem right.
Right.
And it could be another replay of 2008. Obviously, this is where a guy like Powell should step in and say, no, this is completely firewalled. Or maybe even Biden has to step in and say, look, the banking system in America is the strongest it's ever been. Because let's take the final point. If you're an international player and you have money in the U.S. at Silicon Valley Bank, do you really think you're going to trust any money in any U.S. bank at all? Right. You're sitting there in England, or you're sitting there wherever in Europe, because the rates have been higher here in banks, say 4%. In Europe, it might be 2%. So they're arbitraging that, and all of a sudden they're saying, holy shit, that was a much higher risk than being in a German bank or being in a French bank or being in a British bank.
Yeah.
I've seen some interesting stuff over the weekend for sure, Joe. I agree with you.
Yeah, let's try to do a follow-up podcast next week. Let's give it some time to resonate and settle in, maybe next Wednesday or Thursday. But this will be something interesting to follow.
Absolutely. Great, Joe. Thanks for doing it. I'll talk to you later. Take care.
Take care, Jeff. All right. Bye-bye.
Tune in next time on The Valley Current.